Welcome back to Author's Note. Greater regulation and the impact of the eurozone debt crisis are pushing banks to shrink their balance sheets and reassess how much money they need to borrow from investors in public debt markets. Hundreds of banks borrowed cheaply from the European Central Bank in December and February. UK banks, meanwhile, are taking advantage of the Bank of England's Funding for Lending scheme. But what does the new environment mean for bank bond issuance? Joining me to discuss some of the funding issues facing banks at the moment is Gareth Davies, Head of European ABS and Covered Bond Research at JPMorgan. Gareth, welcome.
Good morning.
Well, it's been a sort of abnormal year for banks in terms of what they've been issuing. And I know we've got a chart having a look at sort of levels of issuance versus other years. And I was hoping you could tell me a little about what this means.
If we look at senior funding from European banks, we have obviously the unsecured side, which if you look at it over history, while declining, has been relatively marginal changes. But if you look at the secured funding, which is obviously a large part of European banks' funding needs.
Those are bonds backed by
collateral, whether that be mortgages or other assets that a bank has originated from the real economy. You can see that there's been a huge increase in covered bonds over the 3 years of the, late credit crunch and the early sovereign crisis, but then a very significant decrease in 2012 year to date.
And what was behind the sort of increase and the recent decrease then?
It's generally been a fear of investors in terms of, a rush to quality. And when you're concerned about the viability of European banks, what you really want to get hold of is their assets. So you feel that the recovery eventually, should they get into difficulty, will be much higher being in the secured space. Securitisation over that period has almost resumed from the dead. It was obviously embroiled in the original credit crisis to a great extent, and covereds has just had a significantly, divergent 2012.
And within securitisation, that sort of residential mortgage-backed securities and commercial mortgage-backed securities, isn't it?
So resi mortgages account for about 60% of any issuance in a given year. Commercial would probably be in pre-crisis anywhere between 10 to 20%. Much less in recent times because of, a general aversion to a less granular risk.
Yes.
People have been obviously very cognizant of the fact that they want to be in senior bonds, granular consumer risk over the period. So CMBS has been slower to recover since the end of the first credit crisis.
But we have seen a couple of deals recently, haven't we?
We have seen a few deals. They have basically been what we would call pure play or very clean deals. Pre-crisis, they tended to be conduits, so a mix of assets across a number of jurisdictions or individual property types, retail, industrial, commercial properties. Now we're, restarting the market. We're starting back at the basics, so plain vanilla securities.
Shall we have a look at your next chart? This is looking at what the cost of funding for banks. And what's affecting that at the moment?
Well, one of the, biggest changes we had over the course of the crisis is the role of the official sector, so the role of the Bank of England or the European Central Bank in providing alternatives to selling bonds to investors. This is just a very simple kind of overview. If we take 100 of mortgages, so a bar on the right, and we try and package them up into securities that investors will buy, we can see we get the RMBS or we get the covered bonds. The alternatives we have are the next two bars, are basically giving them to the Bank of England through the Funding for Lending scheme, or giving them to the ECB through the repo facility. What we generally find, because the market has essentially become a Northern European preserve because of people's aversion to peripheral risk, that the announcement of schemes such as the bank's Funding for Lending scheme in the UK has significantly repriced assets.
Interesting.
So effectively we're talking about now that Northern European originators are incentivized to actually issue bonds rather than rely on the official sector. The official sector is really the crutch for the peripheral jurisdictions.
Okay. And what do you think is going to happen next year?
Without the LTRO option, we'll see more Northern European debt placed with investors. For Southern European investors, I don't think they have an option, to be perfectly honest. While you could tier the banks based on their size, so the largest international banks are bound to be able to sell paper into the market, the smaller tier 2 banks are probably going to be excluded from distributed markets, still going to be relying on the official sector. What ultimately it means is that we have a massive compression in yields, because effectively we're going to get more of the high quality stuff and less kind of yieldy opportunities.
Thanks very much, Gareth. As Gareth made the point, next year is going to be a very interesting year for European banks.